Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday, the 22nd of April, 2022. As always, this is general commentary and doesn't take your personal situation into account. All right, with that said, let's jump to our first chart. Okay, so we've got the S&P 500 on the screen. And last week we were talking about the need for the market to really come in around here and hold the line. We talked about the need for the buyers to come in, really buy the dip to support the market and start to push it higher. And early in the week, that was pretty much what we saw happening. And we did get a bit of a rise in the early part of the week. But what's happened on Thursday? So Thursday was quite an upheaval in the market, really, because there was the market got itself spooked. Got spooked by talk of the Fed raising rates by 50 points multiple times. And one of the investment banks, Nomura Holdings, it came out and said it's expecting 2 75-point rate hikes. So that really sent the market into a mini tailspin, and we got this big down day on Thursday. So look, I think it's really a case of the interest rate pan is now really heating up. There's a lot of talk of these rate hikes around the higher inflation rates that we've been seeing in the US over the last few months. So it's really interesting to take a close look at this price action. So let's skip over to the hourly chart just to get some more detail on the move. And you can see the move from last night here. You can see it was quite a sharp move compared to this steady grinding rally we'd been getting through the week, which was looking fairly constructive. We got that by the dip that we were talking about, and it did look constructive, but it's all been unwound very quickly. So let me just compress this a little bit and let's get some more data so we can start to analyze this chart. And what's happened is the market's come back to support. So we can find a support region in through there, and that's around that 4,350 mark. You can see it picks up some lows here, a couple more lows here, and then here we are now right on that support band. And well, it's going to be really interesting to see how the market handles this from here. So what we can also do, we can also put on some Fibonacci's, and we just do the Fibonacci's for that whole leg high that we had from March from mid-March through to the end of March. And you can see we're right here in the 50% retracement area. So we're right in this Fibonacci pocket where you'd expect the market to find support if that's what's going to happen. And look, there's a lot of talk out there now and about interest rates and inflation. A lot of talk going on. But what's really interesting just here is the market is still managing to hold the line around this key 50% region. And I think it's going to be very interesting on Friday in the US to see what happens, to see whether this level can continue holding. So by the time you watch this, you'll be watching this, well, after Friday, because I'm recording this on Thursday afternoon Australian time. So when you watch this maybe on over the weekend, you'll have the answer to what happened on Friday in the US. But what I'm thinking is that if the market can hold around here, it could quickly snap back next week, back up towards 4,400 and beyond. And I still think that a retest up towards this 4,600 level. I still think the possibility of a retest up here is on the table. To me, this whole structure. So if we just let's go to a 4-hourly chart, get a bit more depth of data. Look, to me, this whole structure here, it doesn't look like it's set up for a sizable fall. It's anything's possible, and this could of course change. But at this point in time, my feeling is the market will hold here, and I think there's a strong possibility that we do still see some sort of a bounce higher. So I'm not talking about a new bull market. I'm just talking about, I don't think the market's going to continue to fall away here. I think it's more likely to have some sort of a bounce. Now, let's go over and have a look at the Nasdaq, because of course that's also a big part of this puzzle and trying to work out where the markets are at this point in time. So I'll go back to our daily chart. Let's start on our daily chart. And the first thing you notice with the Nasdaq is that it continues to lag the S&P 500. And I think it remains vulnerable simply because it's trading below these moving averages. So it's below the 50 and the 100-day moving averages. So it does add some vulnerability to the market. I don't want to be buying here. I don't want to be preempting a low. I think that's a risky play. Whilst I do think that potential for a rebound is very much on the table, I don't want to be buying stocks or indices when they're below these moving averages. I think it increases your risk of a blind side, of something happening and a sharp move going against you. But look, I equally don't want to be selling here because of those factors I was talking about. So if anything, I'm just going to be neutral. I'm neutral on the US market at that point, but with that slight bias to getting some sort of rebound to the upside. Yeah, look, when I look at this, I think this market does look stretched to the downside. It feels a bit like a rubber band that's been pulled back, and it does want to sort of like release in that direction. And I'm also mindful of this pattern, this potential pattern, this potential head and shoulders formation. So we have the left shoulder, we have the head, and this is possibly the makings of a right shoulder. And I've discussed this previously and discussed head and shoulders in general. So that would, like a rebound high, could take us up to the neckline, pull back, then a break above, and that's how you start to get a retest of these higher levels. Doesn't mean it's going to continue to follow through on the upside, but that's what a head and shoulders pattern could do. And the sort of psychology, the market psychology, market mindset that I'm seeing and reading about at the moment, it very much fits the personality of this part of the pattern, in that the market starts to fall away with people remaining skeptical, remaining bearish, and expecting lower levels, expecting a new low beneath this what we call the head. And when that doesn't happen, the market then finds itself reversing course, and those who are short cover, those who want to buy, the early buyers start coming in, and it fuels this upward move. So that's the theory behind the head and shoulders. They don't always work. I find they're not the most reliable of the patterns, but they do. They can be useful. Sometimes they just it just continues to fall away, and that's not my base case by any means. But it's always a possibility. That's what I'm favouring. I'm favouring that we are going to hold and that we do rally. But I don't think this is a really great tradable opportunity. I think it's one to probably sit and watch. And look, if you're getting some value from these videos, please hit that like button. Please leave a short comment. Just, hey, like the video, thanks. Something simple. Tells YouTube that people are watching, people are engaging. YouTube shows more people, and I keep making the videos. So please do that. Really does help. And so let's move across to Europe, because I had some requests to have a look at these European markets. And so let me just find where I've got Europe. Here we go. So this is the Euro STOXX 50. So it's got some of those bigger stocks in Europe in this index. And look, what we've got here. This is another market which I've got to say I'm just neutral on. Maybe we're starting to form a base here. You could very much come up with a case that this is some sort of a base here. Then we push higher and we go up. that's well within the bounds of possibility. But for me, we're, again, I say, we're below these moving averages. We're below a heavy resistance band above. So to me, it doesn't seem like an asymmetric trade where the reward is on our favour to be buying so close to the underside of a resistance band. What if it doesn't do what we just did then and punch higher? What if it starts to roll over? So the risk reward just doesn't suit me. Could happen, but this is a market which I'd rather look. I think there's better opportunities elsewhere at the moment. Looking at the DAX German market, similar sort of pattern, very similar pattern. We've got the overhead resistance below the moving averages. I'd rather wait and see and look elsewhere. All that said, though, it is interesting in that what we're seeing through here is quite similar to what we saw through here at the COVID lows. So we had the sharp sell-off, we had the quick rebound, like we have here, the sharp sell-off, the quick rebound, then it was a pullback, it was sort of a bit of meander sideways and then upwards. And very much like what happened back in 2020. So there is a pathway higher for this market, but it always comes back to risk versus reward. Is the risk low enough to make the reward worth chasing, or the other way around? Is the reward great enough to make the risk worth taking? So either way you cut it, I just don't know. I don't think this market's for me at the moment. So moving to the Australian market, the ASX 200, which is looking interesting as well. So ASX 200, another constructive week, another really constructive week in the ASX 200. I think, look, with this, we've tested the resistance band. We've tested this resistance at around 7,600. Did that on earlier in the week, Tuesday, Wednesday did that, and just here on Thursday, we're pulling back from the resistance area. So it's almost like we have a triple top at the moment, although this is like far too early to say that. Well, so we're still calling this a double top with the potential of a triple top. But I think what's most likely to happen is that maybe the market's going to just needs to continue to coil up around underneath this resistance band before it can push higher. My base case is that we still push higher. I still think the All Ordinaries, or not the All Ordinaries, the ASX 200. I think the ASX 200 is set to make a new all-time high. Time will tell. A pause would just give the moving averages a chance to catch up as well, but it does look good. So unlike the European and the US markets, the ASX 200 is above those moving averages, and structurally it's one of the strongest markets in the developed world at the moment. I've remained long. I'm still long the market. I've stayed long all through this period here, through these sell-offs. Of course, I've lost some stocks along the way, stocks which have hit their trailing stops, but I've got other stocks which I've held from. There's a few stocks I've got still from when I was buying back in I think late 2000, which remain on my portfolio. They've got those wide trailing stops, so they've been able to see off this moderate bout of volatility at least so far, and I'm staying with those long established trends, and that's what's giving my portfolio its outperformance. So far, this is an event which could be traded through with the right sort of strategies, and that big broader trend is, I think we've got to still say, is up for the ASX 200. Now, I had one more request I'll look at today, and that was I was asked by one of the viewers to check out the Small Ordinaries, the ASX Small Ordinaries Index, which is a collection of smaller ASX stocks. We just call up a chart of that, and yeah, so just looking at the last 18 months or so. doesn't look as good as the ASX 200. So the ASX 200 is testing up here at the moment. You know, these highs here. So we've got a resistance band up there on the small ordinaries, and the market's quite a bit below there. So we just measure that. It would take a rally of around 7% to sort of get back up there, whereas the ASX 200 is pretty much there. It's also teetering on the point where it's going to fall back below its moving averages. So it just doesn't look as strong. And this is why I think stock selection is so important. So whilst I think there are a lot of really well-performed stocks in the small ordinaries, I wouldn't want to buy a small ordinaries ETF, for instance, which takes a basket of the entire index. I'd rather buy the components that are doing well. And those components are very much there, but they're being held back at the moment, I think, by the parts that aren't doing so well. And it's interesting, if we just compress this a bit, just take off that resistance band. If we just compress this, let's say we go back to around mid-2015, and we just measure out what the performance has been like. So the market's up something like 60% over the last, 70% over the last 6.5 years or so. So it comes to something like, on average, something like 10% per annum. So that's pretty good, and that's before dividends. So the small ordinaries actually has been quite a well-performed market over the last 6 or so years. But what I want to do now, I want to show you the difference that stock selection can make. So rather than just buying a whole index worth of stocks, getting the good parts, getting the bad parts, I want to show you what a difference it can make when you do stock selection from within an index. So to do that, let me show you this. This is my own personal portfolio, the simulation I use for my own personal portfolio. And from this, I get the stocks that I buy and the stocks that I sell. And this is since October 2015. Around the same time, I just measured out the performance of the small ordinaries. And what's different with this is that I'm focusing on smaller stocks, or the small ordinaries, and I'm focusing on smaller stocks as well, but not just any stock. I'm not buying a stock just because it's small or just because it's in a particular index. They've got to meet a particular criteria. So for me, it's all about trend following characteristics. They've got to be trading above their moving averages. They've got to be stocks which are rising, so I'm buying with the trend. They can't have an excessive volatility profile. And then it's about giving them those wide trailing stops so that they've got plenty of room to run and pause and consolidate and then run again. And then that's how I'm able to hold on to some of these stocks which go up big triple digits. I think the best performer is currently up about 800% or something. Then there's a host of others that around 400 or 300, 200. It's that's where all my gains come from, and then they well and truly pay for the losses, the ones that don't work out, which are all part of the strategy as well. It's not about everything's a winner; you get those losses too. But this stock selection process. This is what's working. So this simulation's up something like 160 odd percent versus around 60% over the same period for the small ordinary. So this is averaging out at something like 25% a year rather than 10% a year. So it's all about selling or avoiding those components that aren't working, like those ones which are stuck in ranges or in downtrends. So staying away from them and then holding the parts that are doing well. So it's cherry picking. You're cherry picking the best part of the market that you're focused on. And that's what I do with my Motion Trader subscription service. So, if you want to have a look at that, if you want to check that out, I'll leave a link to a 2-week free trial at the top of the comments section. But that's what I'm using for the portfolio you can see on the screen now. And I'll give you an example. I want to give you an example of the sort of stock, the sort of chart profile anyway, the sort of chart profile that I avoid. And this is really interesting. It's a stock from this week. And let me just call it up. in the news, so you probably would have heard about this, Netflix. So Netflix, of course, isn't a small stock. It's not a stock which I'd consider for my portfolio anyway, because it's not ASX, it's giant stock. But it's a pattern. It's a pattern I'm most interested in. It's a sort of pattern that's common to all types of stocks, big, small, middle, mining, tech, you name it, value. This sort of pattern is typical of all types of stocks. And I've been saying, if you've been following this series, you'd know that I'm always talking about avoiding stocks and not buying the dip when the share price is below the moving averages. Because as I'm always saying, all the bad stuff happens when a stock is below the moving averages, the 50 and the 100 day. Sure enough, bad stuff happened. Bad stuff happened to Netflix this week. It was down 20-odd%. It absolutely got smashed on the back of not bringing on enough new subscribers. So these are the perils. These are the perils of trading against the trend, trying to buy dips and trying to buy stocks which are below their moving averages. You run the risk of catastrophic downside. Bad things can happen, up here as well, but this is the most vulnerable part of the stock cycle. So, these are the things I'm doing. These are the things I'm doing for stock selection, stock exits, and trying to put the odds in my favour and, of course, in your favour as well. So, look, let's leave it there for today. That's a wrap. Please give me a like if you got some value, and I look forward to coming back and talking to you next week. Until then.